everyone. How you doing today? This is Andrew Casertano, financial advisor with the Connect podcast. I have a very special guest here today, Daniel Church, Senior Regional Vice President of Blue Rock. How you doing today, Dan?
I'm doing great. Thanks,
Good,
Andrew.
good. I'm really looking forward to having a conversation with you today about alternatives and what they are and why they're important for a client and their portfolio. I guess that's my first question to you is why are alternatives important? Why not just have all your money in the stock market?
Yeah, that's a good starting point, Andrew. The world of investing encompasses so many different things, um, and we could go through those. But if you really wanted to kind of break it down into three broad categories, you've got stocks, as you've just mentioned, and then you've got bonds, which a lot of folks use for a more safety play or a more income-oriented investment. And then you've got this world of alternative investments, and these are investments that can cover a range of things that aren't your typical liquid investments like stocks and bonds, but historically, they'll help bring diversification into a portfolio and hopefully higher returns. And they almost always bring in a diversification piece from a lowering of volatility standpoint. So when you hear that word alternatives, it's not stocks and bonds and daily liquid things historically. It's things like real estate, um, private loans, or they call that private debt, private equity. These are ownerships and loans to private companies. There's things that are as crazy as art and gold and commodities. Those are all, I shouldn't say crazy, but those are kind of your niche subsectors of the alternative world. But it's a sector that most or many investors have or should have some piece in because it can help dampen the volatility of their portfolios over the long term.
Absolutely. So you mentioned real estate, you mentioned art, you mentioned yeah, crypto. I'm sure you'd assume or you put as
That's
an
all.
alternative as well, things
That's right.
like that. Not that I want to get too into crypto, but what other alternatives are there? And can you talk about why investing? Because the problem that a lot of investors have is that they aren't diversified in real estate or all these different other things, oil, gas, uh, all these sophisticated alternatives that a lot of people don't think of, or they have all their money in the stock market. So something happens like 08, 09, and there's a big crash. Like you said, having these solutions in a portfolio can reduce volatility and sometimes enhance returns as well. Because if you're having better, you know, if a market crash and you have less, the alternatives go down less than a portfolio, then it's going to make your portfolio look a lot better, hypothetically. So the benefit to clients is that it kind of smooths out a portfolio's returns.
Yeah, absolutely. In fact, if you think back just a couple years ago to the year 2022, when the Fed went on a very aggressive rate hike scenario, you saw not only stocks drop in value, but you saw bonds drop as well. And that's unusual when those two categories move in tandem. Usually they're one zigging and the other zagging. And and yet you had during that year what we call private institutional real estate, or sometimes it's referred to as institutional commercial real estate. You had that sector up anywhere from 5 to 10%. So there's your zig and your zag. There's your alternative and your non-correlation. Now, if we look at the last 18 months or so, it's been the exact opposite. Bonds have been kind of flat, but stocks have gone to the moon, as at least of this recording, and real estate has pulled back some. So it's I kind of think of it as when I was a kid and I used to go to the ocean and we'd see a school of fish, and if you spooked them, they would either all swim away together or they would scatter. Well, your investment portfolio needs to be more of the latter. You want things going in different directions so that you're not getting all the ups and all the downs, which can be much more dramatic than having some alternatives in there, which will make things a little smoother ride.
Yeah, absolutely. Can you talk a little bit about the liquidity of some of these alternatives? Because a lot of people are just used to, a stock, a bond, you can, pretty much sell immediately and get out. Um, these sometimes are a little less liquid, but, and can you talk a little bit about why that is?
Yeah, and I'm going to reference real estate quite a bit during our conversation because it's usually the easiest one, and a lot of people own their homes or they own land or they own some type of commercial building, so they'll relate to it a little bit more. But if you want to run down another road, I'm happy to share what I know on other things in the alternative space. But um, if you think about owning a piece of real estate, whatever it might be, um, you can get some kind of a valuation on that if you have an appraisal done, but that takes time. And those aren't, you can't buy a piece of real estate today and sell it tomorrow and do it again the next day and the next day. That takes time. So this category is considered in many cases an illiquid or a less liquid category, but you can get real valuations done periodically, and those valuations then get added to your portfolio in the shape of performance and returns and things of that nature. What you can't get, like you can with stocks and bonds, as you just pointed out, you can't get quick liquidity with alternative investments and real estate in particular. Sometimes it takes some time for the sponsors and the owners of those real estate investments to sell out so that they can get liquidity and provide it to the investors.
So what should clients expect with liquidity? Should they expect like monthly, quarterly? How does it work for most of these type of funds?
Well, it's migrated over the last few decades. So if you go back 20 years ago, the most prolific or demanded alternative investment was the real estate investment trust. They called them non-traded REITs, and those were investments where an investor invested some money with a sponsor that was investing in some type of real estate. It might have been shopping centers, it might have been office buildings, or industrial distribution center, and all different types. And as you invested in those types of REITs, you were expected to tie your money up maybe 5 to 10 years. It just depends on where we were in the economic cycle and how quickly those turned out a performance. Now, they did allow some liquidity, so they might allow 10% liquidity a year, um, based on whether they could get the liquidity from sales of their properties. That's changed. Today, there are investments that are called interval funds. And I think many investors listening to this may know the word mutual fund, but an interval fund is like a mutual fund, but instead of having daily liquidity, it has quarterly liquidity, not 100% every quarter, but they're supposed to require or they're supposed to have available at least some liquidity on a quarterly basis, and they can never shut down and limit that liquidity to zero. They always have to have, like the standard in interval funds is, if the interval fund is managing $1 billion worth of real estate, they've every quarter they've got to have at least 5% of that available to pay out to those investors that need the liquidity. That's a more liquid version of what things looked like about 20 years ago in that non-traded REIT space.
Gotcha. So, and just to clarify, when you say 5% liquidity, you're talking about not, they want to make sure that there's not a run on the bank and everyone's pulling out their money immediately. But like if you put, let's say a client has $100,000 with them, and they pull that out, and it's less than the total of 5% liquidity that everyone wants to pull out, then they'll get access to that entire 100,000. It's only when
That's right.
there is everyone trying to pull out their money at the same time that there's an issue.
That's exactly right. Yeah. As a reminder, those sponsors and the makers of those investments aren't sitting on a pile of cash. They've got that cash invested in bricks and mortar and real alternative investments, and those investments just aren't daily liquid. So this, if you think about it from a big picture, this isn't half of my investment portfolio. This is usually a smaller piece of the pie, maybe a 5 or 10% piece, maybe a little higher than that, depending on my net worth and what I can afford to not touch for 5 or 7 years, but it is longer term minded. And over that longer term, historically speaking, it should provide some benefit both on the performance side and on a lower volatility side. It's just not as liquid, to your point.
Gotcha, gotcha. And can you touch on the differences between a REIT and an interval fund? Because I think people are a little more familiar with REITs. Maybe they're not, but can you talk about the main differences between the two?
Yeah, I'll do it in kind of a three-step or stage. The world of REITs was created, I don't know when, but decades ago, so that a stock, instead of inventing computers or computer chips, the stock could invest in real estate. And there are tax benefits by investing in real estate and by managing them certain ways. But there's still a stock. And the stock is technically called a real estate investment trust, an REIT or a REIT. And those stocks trade sometimes as volatile as the S&P 500, and you can get in them today and out of them tomorrow, or in them and out of them every week or whatever. They're just like a stock, but inside of that stock is real estate. Now those are publicly traded, and there's a bunch of them out there on the stock market. There's actually mutual funds that invest in nothing but these publicly traded REITs. The second stage is what's called a non-traded REIT, and these are the less liquid kind. This is more of an alternative investment because those companies, those REIT, the REIT companies, own the real estate, but they're not publicly traded. So if I'm investing in a non-traded REIT, I'm then mentally committing myself toward a longer time frame and a less liquid withdrawal type process. The interval fund was created about 20 years ago to try to bring those two under the same roof, but not exactly like a mutual fund, because a mutual fund provides liquidity every single day if you want it, as much as you want. But the interval fund does allow quarterly liquidity, and the interval fund typically doesn't own the real estate. They're investing in managers that own the real estate. So the owner, the manager, the company that created that interval fund is kind of like a conductor, and the conductor is trying to add a trumpet player over here and maybe get rid of a violin player over here. And what I mean by that is they're trying to choose and fire or get rid of the best sectors and the best real estate managers, and they do that on a daily basis within the interval fund. But the client is getting real estate type returns on their investments, whether they're up or down, and then they're getting access to professionally managed portfolios of real estate, and then they're committing to limited liquidity in some cases on a quarterly basis. Sometimes, as you said earlier, the liquidity can be full, can be 100%, but they have to be mentally prepared in an interval fund to maybe not get all of their money out every single quarter. It just depends on like we said earlier, is there a run on the bank? Is there too big of a request for liquidity given any given quarter? So you've got public REITs, non-traded REITs, and then interval funds, which is kind of a nice umbrella over those other two.
Gotcha. Okay, so it sounds more like you guys are managing the managers. Can you go into what I heard you say non-traded a few times? What does that mean? Does that just mean that it has, it's an illiquid investment, it's non-traded?
Yes, exactly right.
Okay.
There's not a ticker symbol. There's no exchange to buy or sell that. You're literally, as an investor, working more than likely with a financial advisor or a professional, and you've read a prospectus, you've seen the literature, you know what they're investing in, and when you make that decision to go into a non-traded REIT, you're filling out an application, and then you're checking the statement that they send you once a quarter or so. And usually with the non-traded REIT world, just like with your house, you're seeing your statement move slightly, just like you wouldn't, if nobody does this, but if you were to get an appraisal done on your house, every quarter or maybe even every 6 months, you wouldn't see that price move much at all. And that's kind of how the non-traded REIT world is. It owns the real estate, it invests in the real estate, and the share price stays fairly stable from quarter to quarter and from year to year.
Absolutely. And if I was listening to this podcast right now, I'd be thinking like, okay, so what? Like, why don't I just do this myself? Why don't I buy the fixer upper across the street and start my own interval fund or start my own REIT? But it seems like one of the advantages of utilizing these is one, you're gonna be more diversified versus if you're buying across the street, in Maryland or wherever you are. There could be, political issues, things like that, maybe people move away from your state. Um, this seems a lot more diversified. Two, it also seems a lot more like automated because you don't have to take the calls at 1 a.m. to change to, fix the toilets and whatnot and take out the trash or whatever. And then third is I don't have a third, but those two are pretty good. Those two are pretty good reasons. Um, is there anything you want to touch on that, or I'm assuming you agree with me on that front, correct?
Yeah, actually, I'll throw in a third and work it backwards.
Oh, perfect, awesome.
Well, when you do it yourself, if you will, and you buy a rental home or something that's more affordable, you get all of the problems with the benefits, like you were saying, the toilets and trash and all of the things that can go wrong with owning a property like that. But you do get some tax write-offs, and those are nice to be able to write off on your taxes and see uh, possibly a higher net return or taxable equivalent return, as we say. This could be a manager that has investments in data centers, which is kind of a hot market right now, or retail shopping centers, or retail big. There's so many different types of the commercial real estate property that it would be hard for an individual to really get some diversification by trying to find a portfolio. I mean, I'd also have to have a ton of money, right, to really
Yeah.
diversify my portfolio. An interval fund does that all for you, and it's done with the most professional and institutional managers that are out there. Um, so yeah, I mean, I think there's at least the two benefits that you mentioned. Then the tax benefits are as good, or at least they're out there like you would have if you made the investment yourself.
Yeah, and I'd like to for you to touch on the tax benefits a little more, but I just thought of a fourth one, which you kind of touched on, which is like the low threshold. So, for example, if you're trying to buy, $1 million house, you're gonna have to come up with significant money to buy that house, compared
Yeah.
to an interval fund could be, just a couple $1,000s to get started. So that's another benefit.
Yeah, I mean, if you were to look at most of the interval funds out there, they're minimum something like 2,500 or maybe $5,000, and then you're getting a piece of 10 or 20, or in our case 30 plus managers, and you're getting like a tiny piece of each one of the properties in their portfolios, if you will. So yeah, you're getting really broad diversification in most of the interval funds out there for like you said, a very small amount of investments, or larger. I mean, whatever is appropriate for the individual investor.
And then touching on the taxes, can you talk about the tax benefits to interval fund and kind of how do they pay out? Are they like dividends? Are they like capital gains, appreciation?
Yeah, the interval fund, because there's a multitude of managers. You called it a fund of funds or a fund of managers. Each of those individual managers are managing their portfolios for their benefits, for the benefit of the most performance or the most yield and income. And in order to do that effectively, they'll try to lower the taxation from the income side of things, and maybe they'll try to hold on to things a little longer to get some benefit out of capital gains rate of taxation. What the interval fund does is it takes into account all of those tax benefits and strategies and gives it to the investor in the form of a 1099. It's no different than what I might get on some of my bank investments. It's very simple for those that do their own taxes or that turn it over to a CPA accountant. And that 1099 form says, okay, well, only a piece of this is going to be taxed at your highest and ordinary income tax bracket. It might be 25, 35% or so historically in a product like ours. But the rest of it is non-taxable today, and will remain non-taxable until I sell out of the investment, or if I happen to pass away, the beneficiary doesn't pay taxes on any of it. They get what's called a step up in the cost basis. So it could theoretically be left to someone where no taxes are paid on the gains that might have been earned over the years.
Makes sense. Yeah, it sounds like there's a lot of good tax benefits to investing in something like this.
Yeah,
And then, yeah, go
yeah.
ahead.
No, well, I was
I
just going to
just,
say, there's numbers out there with every interval fund and what they're investing in, and some of them aren't in real estate, some of them invest in other things where there aren't tax advantages. But having worked for one now for 8 years, the real estate interval fund, at least ours, has historically been somewhere around 60 to 65% tax advantaged, where I'm not paying taxes at the highest income bracket of each individual investor on a year over year basis. There's some real nice benefits there that lower that tax rate.
so it seems like someone who has, a significant income, they're in a high tax bracket, and that they have, non-qualified money, which is, taxable money. This is definitely something that they would wanna look at.
Yeah, it could be. I mean, we really like to promote the idea of alternative investments and a financial advisor. Um, I can conduct surgery on myself, I guess. I mean, I could try, but and I say that from a standpoint. I guess I could pick a good portfolio of stocks or mutual funds or possibly even bonds. But when you start to bring in alternatives to the equation, it's a master's level type of addition I'm making there, and I want to have some direction and some help from a good financial advisor to work through those illiquidity issues or the taxation issues, tax benefit issues, things like that. So it can be very beneficial in times, and to have some help there wouldn't be out of the question at all.
Absolutely, absolutely. I think that answers all the questions I had for you today. What so leaving as we wrap up here, any last thoughts you have or anything else you want to add?
No, I think I mean, yes, I'll just mention one last thing, and it kind of piggybacks what I just said by using a financial advisor. Um, it seems like and I've been in the business quite a while, almost 40 years, but it seems like with the addition of the internet and access to all of the different mutual funds that are online now, that the average investor can do a lot on their own. And that's probably true. I think it's always helpful, no matter what it is, to have a second pair of eyes to look at my portfolio and see if there aren't some advantages that can be made by making some switches. But when you think about this world of alternative investments, the real big player, the real big investors in this world are your big pension funds and your endowments. There's a gentleman's name by the name of David Swenson, who was the lead over the Yale endowment for, if I'm not mistaken, close to 40 years. He passed away not too long ago. But when he came in to run that endowment, he took the endowment's investments that were predominantly in stocks and bonds, and he started adding alternatives. Big piece of that alternative category was the real estate sector. And all of a sudden, the returns of that portfolio really started to show up nicely. And when they were compared against some of the other big endowments that weren't using alternatives, the differences were dramatic. And then you see, probably in the early 90s or so, you start to see the Harvard Endowment and the Ford Motor Pension Fund and the California State Teachers Retirement System. You're starting to see them add these alternative investments. But they've got the manpower and they've got the intellectual power to pick and choose the right ones to add to those portfolios. Well, the good news is, the average investor has that manpower by using a financial advisor to help to begin introducing alternative investments to their portfolios. So that's kind of what I'd like to leave it with. Don't try to conduct the brain surgery on yourself. Get some help. There's nothing wrong with asking.
Yeah, I love that point. I'm very glad you mentioned it because I forgot to mention it, which is that working on these are some things that retail investors just don't have access to. And by retail, I mean the everyday investor. Unless you have millions or tens of millions of dollars, you're not gonna, all these big companies are not gonna be knocking down your door, asking you to invest in these sophisticated investments. So that is where, there's a nice niche there for financial advisors to come in and help you further diversify, or, some of these other hedging strategies, that that everyday investors don't have access to. So thank you for making that point. I should have made that. That was a good one.
Well,
So to wrap up, we've talked about, alternatives and why they're so important. And, the next step I would, recommend for people is to talk with a financial advisor and let them look over and, figure out their alternative philosophy and how they can help you further diversify.
absolutely. Yep. Yep.
All right, Dan. Well, it's great having you. Thank you so much for being on the Connect podcast. Thank you, everyone who is listening, and don't forget to subscribe. And I'll catch everyone soon. Thanks a lot.
Thank you.
Take care.